In this video, we're going to talk about the Dupont Analysis. Essentially what this does is it allows us to take a further look into the return on equity ratio. So we want to be able to understand what kind of decisions do management make in order to increase or provide a decent return on equity to the owners of the company. And it's a fairly simple formula. If you take the net profit margin, again, these, if you remember, these little yellow boxes should give us ideas of what's in these cells. Net profit margin, this is the total asset turnover ratio, and this is the financial leverage multiplier. Essentially, this is a measure of leverage, obviously, but larger numbers reflect greater amounts of debt. And this is just a product. The return on equity is the product of net profit margin and total asset turnover. So if we look at this company in 2013, their net profit margin was 13.56. Total asset turnover was 0.27. When you multiply those together, the return on assets was 3.662. So that's the rate of return that they earned on average on the assets of the company. The financial leverage multiplier, again, tells us about how much debt the company has. When you multiply that times the return on assets, you get return on equity. So in this case, the return on equity for the company is 6.61%. So how can we understand what's going on inside this company? So let's look at what's happening to net profit margin. You can see that net profit margin is fairly steady with the exception of 2016. Now, I'm not sure what happened to this company in 2016, but its net profit margin was huge. Possibility could be that there was a major write-off a major inflow of cash flow from maybe adding a company. So now we have two companies added together for this net profit margin. But regardless, it's just a number. So we can see that it's fairly steady over time, though. So what happens to the efficiency with the company? And again, we see that the numbers are fairly steady. We had a little bit of an uptick in 2017, but the numbers are fairly close. So if we kind of ignore 2016, we can see that the rate of return on investments is roughly in the upper threes, 3.6, 3.7, 4.6 in 2017. So the profitability on assets is relatively stable over this 5-year time frame. Let's look at leverage. From discussions in classes, etc., you may discuss a lot about borrowing. Borrowing is a decision that management makes. It's not like net profit margin, which is a measure of an outcome of many decisions. The amount that we borrow is a function of a single decision. So management decides to borrow more or they decide to borrow less. That's what this number measures. It measures the outcome from that one single decision about financing. And you can see that it's fairly steady for the first 3 years, but the last 2 years, debt has substantially increased in the company. So what do we see happens? We see relatively close return on equity, and then in the next 2 years, because of this substantial increase in debt, we see a substantial increase in returns. So the question is, how can you increase the returns to owners? You can increase the profitability by which you run the company. You can increase the efficiency with which you run the company. These are operation kinds of questions. The third way you can increase return on equity is to increase the proportion of debt in the capital structure. That is, borrow more money than you get from shareholders. Now, there is, this is the simplest version. We can actually talk about something that's referred to as the extended Dupont. And this extended Dupont, again, you take various methods. These all come from either the ratio section that you may be calculating for a company, or from the company's common size statements, if you will. So here's the EBIT divided by sales. This is the operating profit margin, right? If you subtract from that the interest in sales, we end up with earnings before taxes divided by sales. Again, a common size line item. Here is the total asset turnover ratio. So earnings before taxes divided by total assets is 3.992. The next ratio is total assets divided by common equity. That's our financial leverage multiplier. If you multiply these two together, we end up with EBT divided by common equity. Again, it's a type of a return number, 7.206. Subtract from that the tax piece. We need to know what the average tax is on the company. Now, this isn't the marginal tax rate. This is the average tax that the company pays on EBT. So when you figure out what the average tax is, right, as a percentage of sales, what is that number? So this is a number that comes from a common size statement, not from the income statement. So in this case, on average, as a percentage of sales, this company pays 6.13%. As you can see that in general, the numbers are going to be fairly close to the above ratio. Again, this allows us just to look at some other questions, if you will, delve a little bit deeper into what creates return on equity. So again, this is the basics, if you will, of just really trying to understand what management is doing to create returns for its owners. And then in the end, it gives managers a picture, if you will, of how they can increase the returns that owners may want. So this is the Dupont analysis.